On this video, we're going to talk about private investor finance and why we think it's better than bridging. We're going to talk about the pros and cons of both. Welcome to Property Insight. My name is Neil Harding.
My name's Mark Ashworth. Bridging finance or private investors? Interesting. I've never used bridging. I've always found that whenever I've researched it and looked into it and considered it, in the end, it was just too expensive and too difficult and too complicated. And the lenders, even though they're bridgers, seem to be too risk averse. I mean, I guess they have to do their due diligence and they have to protect themselves. I get that. I'm actually from a background where I've got a very relatively low risk profile. I like to do, if I'm going to do stuff where I require money, if I can't afford to do it myself, it's probably more likely that I'll wait until I can afford it. Rather than borrowing with bridging. But everyone's different, and most people need a bit of backing at the beginning of their careers, or certainly if they're doing a lot of buying and refurbing and refinancing, if it can't be mortgaged, then they want to get the lending on it up front, which obviously sometimes if you can't get a mortgage, it's going to have to be bridging or private finance. But I think the private finance route is probably more akin to people that have perhaps done it before, because trying to take a deal to a private investor and say, I've never refurbed a property before, but this is what I intend to do, will you lend me the money? I think you've probably got a fairly slim chance of anybody being that confident, unless they really know you, of course, unless they might be a relative or someone that you've known all your life. But to actually go and find an investor to invest in that, I think maybe is a bit of a pipe dream. I mean, what's your view on that?
Yeah, it could well be. You probably need some sort of CV in investing before you can get lending from
that's what I mean.
a private investor. It's got to be a really good friend or member of your family, let's say, to be willing to part with a big chunk of cash, certainly six figures, say, to somebody who is doing their very first property investment, perhaps first BRR project. Not sure if I personally would do that. I think you want to see some evidence that they know what they're doing. They've done it a few times, and then it's a bit of a catch-22 for the property investor, because then they think, well, how do I build that CV if I can't get the investment in the first place? And I think that probably leads us to some of the pros and cons of both, because bridges, there will be lenders out there, but they probably are more expensive, who will at least entertain the idea of lending to a first-time property investor or developer, as long as the project, of course, really stacks up and meets their investment criteria. And it's probably got to be a really good deal, but there will be lenders out there that will entertain the idea. And
you need to have some skin in the game in that anyway. I think most lenders are going to insist that you bring something to the party other than your time and your willingness to do the project. I'm not going to say expertise or experience, because if you've not got expertise or experience in the first instance, then they're going to want to have something else, and that's typically going to be a percentage of the project, right? In terms of a deposit or...
With bridging, obviously it has a bit of a reputation as being expensive money, and it is expensive money, so you wouldn't want to take it on lightly. So typically where you're going to need bridging, or for that matter where you might want to take private investor finance, you've probably got a project where you, for one thing, probably can't get a fairly standard buy-to-let mortgage product from a bank, for one thing, which might be that it's not a buy-to-let, it's not ready to buy and immediately let. It might need some heavy renovation. You probably also want to be doing something that's going to add value, not just renovation and refurbishment, but you might want to be reconfiguring, you might want to be doing all sorts of things. And it might just be a problem property, it might just have some sort of problem with it that is a way that you can add value. And that could be all sorts of things. It could be something with the tenant, I suppose. It could be something with the bricks and mortar. It could be all sorts of things, I suppose. But more often than not, there'll be something which means it's quite hard to get, let's say, a more vanilla buy-to-let mortgage product. And that's where private investors have a really good role to play, and perhaps to a lesser extent, bridges. Because bridger lenders will still have their criteria of what they expect to see. So they still want suitable security as an asset for their lend.
I think where bridging probably comes into its own is where you've got a lot more opportunity to add value to perhaps multi-units. So let's say the project was going to return you maybe 3 or 4 or 5 units once you'd finished, and it maybe had some land that you were going to build on or something like that. I think that type of project is probably going to have a better result for you because there's more value to add. Whereas if you're just talking about a single buy-to-let property that you might turn a 2-bed into a 3-bed and you're going to add some value that way, because it's only 1 unit on one property, on one piece of land, and you can't add anything more to it other than a bit of value to the actual property on that one freehold, I think it's probably less akin to bridging, to be fair, because you've got less opportunity to make it a lot better. There's like a ceiling, if you will. And so therefore the cost of your finance and what you can get the deal for, unless you can get a particularly good below market value deal, by the time you come out the other end and you've paid all your finance costs, there isn't any more money that you've made there than just buying a normal buy-to-let without having to do any value that was mortgageable in the first place. So I think it's probably going to be more akin to what type of deal you're doing, what you're looking for. And if it is a straightforward buy and then refinance later, much like some of the ones that you've done and we've spoken about on this channel before, which are essentially auction purchases where the property just needs to be sold, that's probably where you can make money on those kind of deals, where you can use private finance for, which is what we're talking about, rather than bridging, which I see that as bigger projects.
Yeah, that's a really good point. Bridging, I think in particular, has a reputation for being expensive money, but it's not always as expensive as sometimes people think, but it is expensive. So quite often the interest rate will be in and around 1% a month is a broadly fair sort of assumption to take on what the money is going to cost you. So to borrow, if you're borrowing £100,000, you're going to be sort of 1% of that £1,000 a month is roughly what your cost is going to be. Sometimes it's 0.85% a month, sometimes it's 1.1% per month, but that's splitting hairs to some extent. But then on top of that, there's some other things to remember. So sometimes there's a 1% fee on the way in, and sometimes there's a 1 or 2% fee for that matter on the way out. There's an exit fee as well. So it's worth keeping those costs in mind as well. Also, the big thing is, which is a big difference between bridging finance and private investor finance, is the timing of the cash flows on the borrow. So with a bridging lend, you will receive a net advance more often than not. So what I mean by that is the bridging company will deduct from the amount it's lending to you all of its fees and all of its interests all at the very start. So if you're borrowing for 12 months, it will reduce your advance by 12 months worth of interest and you receive the net amount, because they want to make damn sure that they're receiving their interest no matter what. So they don't allow you to pay it off every month and service the interest. They actually require it right at the very beginning. So that's quite an impact on managing the cash flows of your project. Whereas with private investor finance, if you can agree terms with the lender, then you can say, well, I'd like to borrow £100,000 from you and pay you, let's just say 10% interest, and I'll pay you that £10,000 at the end, after you've had a chance to refinance the whole project based on the higher valuation, on the uplift and the value that you've created. Well, that's much easier on your project cash flows. And also, you might actually be able to borrow, if you agree, again, with the lender, 100% of the purchase price. So if £100,000 is what the property's cost and that's what you've borrowed, then great, you've just borrowed 100% of the purchase price. You're probably, I'd say, very unlikely. And if you can do that with a bridger, it'll be very expensive, but it's very unlikely that you'd be able to do that with a bridger, I'd say.
So what sort of fees are you talking about paying a private investor as opposed to a bridger? I suppose the question that some people may be asking is it above board? What makes it a clean borrow, and how does that, what are the mechanics of it? Is it straightforward, and is it as easy to use as a bridge, or is it compliant, should we say?
Yeah, that's a good point. So I think with a private investor, the fees that absolutely will have to be paid for, your own legal fees when your solicitor's representing you, and there'll be legal fees of the solicitor representing the lender. To some extent, you can negotiate and agree between yourselves, between the lender and the borrower, who pays those fees. But I would say typically it's the person borrowing the money that would be paying both of those legal costs. And there is absolutely nothing wrong with the borrower paying the legal fees of the solicitor of the lender. That's fine. That's not a conflict of interest. And that solicitor will still completely independently act for the best interests of the lender.
It's worth saying that those solicitors do need to be different. They don't need to be related in any way.
Yeah, more often than not, absolutely they would be. And I think that's the best thing to do.
So typically what would be happening here is that the solicitor for both parties will be drawing up and signing between them a loan agreement, and also they will be registering a first charge against the property, assuming that that's what you agree. In most instances, whether it's a bridging lender or whether it's a private investor, they would expect you to have, or expect to have, a first charge on the property. And possibly even if you're buying in a limited company or borrowing in a limited company, then they would also expect potentially for you to give a personal guarantee. Exactly the same scenario as if you were taking out a buy-to-let mortgage anyway. They would expect to do a personal guarantee with the borrower anyway. So everything sort of remains the same. The only thing that's different is that it's potentially a private individual who's got some savings rather than a bank. And sometimes it's easier in some respects with the loan agreement with the private investor, because they probably would have a different level of risk attitude towards it. Essentially, as long as they're covered and their loan is covered by the fact that you've given them the first charge on the property, that's probably the most important thing.
Yeah, I think another great reason for using private investor financing is because it actually feels really good, because it feels like a genuine win-win. It'll often be people in your network who could be, I've got people that have lent money to me who I've known since I went to university, sort of 20 plus years ago, and they're able to lend me money because they're in that fantastic position where they can do that, and I'm paying them 10% interest on the lend. That's fantastic. They're getting a nice return. It's helping me, it's helping them. More often than not, actually, people that do that then want to do that all over again. Yeah. And that really helps accelerate your property investing journey. So that's really, really good.
So just as a closing comment or closing points, I think we'll just have a conversation about the level of percentage interest that you would pay a private investor, because I think that's quite a relevant point. You mentioned 10%. In some instances, it could be 12 or 15, and in others, it could be 7 or 8. So in what circumstances may this be? Well, it's going to depend on a few things. Firstly, it's going to depend much on your experience, and then the risk appetite of the person lending, and the ability for the person who's borrowing to deliver exactly what they say they're going to deliver. If there's more risk involved in a particular deal, or if you're lending 100% of the money, and if they're, depending on what the value of the property is against what you're borrowing, that may influence the amount of interest that you pay. So if you're a first time borrower, let's say, and you've not done a project before, it may well be that you need to give a higher interest rate than you would do if you'd have done it time and time and time again. And you've got bags of experience where it would show to that investor that there's a much lower risk of anything going wrong because of your track record. But also it depends on the project. So if the project is, I'm going to buy this property, knock it down and build another one, there's more risks involved in doing something like that than there is just a straightforward refurbish, or even a straightforward buy in auction and refinance later because it's below market value, which has already got a tenant in situ. So you may find that doing a borrow on that from a private investor may attract a slightly lower interest rate because there's a lot lower risk. So that's how you would typically calculate what investment package you put together for a private investor. And it's really important, it's worth mentioning that it's a good idea to create some kind of project package which describes exactly what the project is, the details of it, what you intend to do, a bit about yourself, so that you can give that to somebody, even if you know them, you can give them some kind of document that just describes exactly what you're planning to do, so that it gives them a clear picture to what the investment is and what it involves, and what your proposed rate is as well.
Great advice. Yep. Okay, well, I hope you found that insightful and look forward to seeing you next time. Please do comment, like and subscribe to the channel if you found this content useful.